Bismillahirrahmanirrahim. Thank you, Arslan. Now, guys, as Aslan discussed, that I'm here to present our regression results. But before going into that, it is important that we ensure that the underlying data and the model assumptions that we took for our this topic, they are sound and whether they, stand by the validity of our tests. So for that, we're going to first do a basic series of tests such as descriptive statistics, correlation analysis, multicollinearity, and finally heteroscedasticity test. Now, the purpose of these tests, as I discussed here, is to confirm whether our data is behaving normally as we expected it to be, or the variables that we selected, they are meaningful or they are redundant, or whether any sort of error is impacting our results. First, we'll go with this number one, descriptive statistics. Purpose, it's to understand the behavior of each and every variable and whether they are volatile or not. Then we'd go with the correlation analysis. This will put up to see whether our relationships, they are collinear or they correlate, and whether the relationship is any strong or weak. Then finally, we'll go with multicollinearity check. That is to see whether our variables are, or one or two, multiple variables are collinear. So this will definitely impact our results. So we don't want that. So we'll check whether our variables, two or more, are multicollinear. And then finally, heteroscedasticity, to confirm whether some constant error is within our results, constant variance. So which will also have a significant impact if it is there. Now, going to the next slide, we'll discuss each one of them separately. This is the descriptive statistics results. Now, recall that what our variables were. So we have wanted to see the impact on US inflation because of the change in oil rates, and the impact of USD, and then finally federal policy rate. Going with the first variable, inflation. Now we see that among all these variables, standard deviation of inflation is the minimum. And if we take three standard deviations, 0.009, and add it to the mean, it will still be almost our within our maximum range. So we can say that the inflation and its data set is maybe with the smallest standard deviation within the narrow range. So it's sort of fairly stable, relatively stable over time. Whereas if we go about oil and we see that the standard deviation is higher, and then if we take its 3 times standard deviation and then the mean, the values are even the maximum minimum values are beyond this range. So definitely there are some maybe outliers, or we already expected somewhat that the change in oil prices is going to be volatile behavior and variable in this analysis. So you can already, from theory, we can explain that this could be because of the COVID or even the global 2008 crisis, because our data set is from 2006 to 2025. So it also includes the impact of COVID as well as 2008 crisis. Then finally we'll go. Then thirdly we'll go with the USD index. It shows moderate variation. There are variables beyond this, but we'll see since US currency is already in USD, so we'll talk about that. And then finally the federal fund rate. We know it's a stepwise response because policy rate doesn't change every month. Usually it stays same, and maybe after a quarter or after months and months it might change. So we'll definitely have an impact. But we ought to know here that all these variables, since we took the first difference of natural logs, so all these changes are basically monthly percentage changes. So by taking the monthly log, by taking the differences of natural logs, we can definitely talk about or maybe capture the short run analysis. So this is all over descriptive statistics. As a summary, you could say, which we have highlighted in fair, inflation remains relatively stable. Oil prices show the highest volatility. US index show a period of some jumps, and then federal funds reflect stepwise policy adjustments. As we talked about, that the federal policy is not, it doesn't change every month or maybe every day. It's maybe a quarter-wise response, but some of the quarters do not, it is not even changed. So we definitely will talk about this when we move on. So now we come to the histograms. Histograms, they basically pictorially represent the behavior of our variables. So we see the inflation, it is almost clustered within its mean value, not heavily skewed, but when it comes to oil, we see there are a lot of skewness here and there, and the value you see is broad. The spectrum is very broad instead of if we talked about inflation. Again, we can talk about or we can contemplate that this could be because of COVID behavior or maybe the recession, where oil impact significantly impacted inflation. Then we talk about histogram of USD index. It shows well moderate skewness. There is somewhat tailing on this side, and then finally the histogram of what we call federal fund rate, policy rate. There are little steps here and there, and then it fairly remains stable in zero, but there are little deviations, maybe because of those stepwise response to the policy rate as was discussed earlier. Next, we talk about time series plots. This is the response of each variable that we had against time. We can see the inflation, and there are a couple of spikes here and there. Maybe the most significant ones here are in 2008 and then 2000 and maybe 2021 and 2022, maybe because of the COVID. But what is most significantly important is that this inflation and oil price, if you look at it, they are showing a similar trend. There are also some spikes here and then maybe here and here, as we already saw in case of inflation. So basically what you can contemplate that oil and this inflation, they are sort of behaving in a similar trend, or they may be co-moving these two variables. So these two variables. Now we talk about USD index change. There are other changes in it, which are definitely there are changes, but these are not maybe collinear with the inflation. Yes, there are somewhat aligned as well. For example, 2008 and 2021, 2022, these impacts are also visible on time series plots of oil and inflation, oil prices and inflation. But there are other spikes. It is moving sort of maybe independently. And then the federal policy rate, we already saw that there are a lot of no changes and then a couple of spikes. So you can, from these, you can easily say that oil emerges as the strongest short run driver maybe to our inflation. So our hypothesis that oil price maybe is the most significant in the short run impacting inflation, it appears to be significant. Now correlation patterns. These are now how correlation is explained. Well, this is the mean value. So as we move towards +1 or -1, the strength of the correlation is increased, and if we remain fairly close to zero, then the correlation is not there. Maybe it's not strongest. And similarly, we can devise about positive or negative behavior. So it could be a positive correlation, it could be a negative correlation. Now we talk about oil and inflation. You see that the trend here from zero, it is sort of maybe strong, uh, a little to the positive side. So I mean, as compared to USD and inflation, you see here it's very lumped together near the zero, and then similarly federal fund, the policy rate impact. So this is a little positive correlation here. And so it tends to rise as the oil prices rise. And our first hypothesis, as we talked about, remains valid. And then if we talk about US index rate, it shows a weak negative correlation, very weak one here you see. And it's not fairly strong. And well, US economy is already in USD, so limited exchange rate pass through. Nonetheless, when it comes to policy rate, well, we also see a minor, maybe weak response since the policy impact, policy rate, the policy changes would be in response to over inflation. I mean, it's not basically causing or causing the inflation to go up and down. It may be it's as a response to the inflation. So a sort of corrective maybe behavior. So this model fairly explains the theory as well. Now we're going with the, as we discussed earlier, the multicollinearity check, the VIF, variance inflation factor. The factor remains below 5 for all of them. And so we can say that our explanatory variables are fine. And these tests are basically to see whether our variables are highly correlated, and if they are, then that would distort our regression results. Now, all the way values our values are below the threshold of 5, maybe 5, let's say. So this is not a concern, and our explanatory variable provides distinctive sort of information. So we can say finally that we can say that our regression values they are is not a problem, and the regression estimates are reliable, maybe stable, as far as the multicollinearity is concerned. Now, finally, the heteroscedasticity test. We conducted 2 tests, Grush-Pagan and White test. Tests are here to see whether some sort of constant error variance is found across our observations, because all these errors will definitely impact our results, all of our results. Now, the tests were conducted. Null hypothesis was that errors do have a constant variance. Grush-Pagan test, p-value is greater than 0.05. So we failed to reject the null hypothesis. So we can say there is no simple, no linear heteroscedasticity. As far as the Weiss test is concerned, the p-value is below 0.05. So we fail to we suggest that there is a sort of complex heteroscedasticity detected. So if we interpret both of these together, we can say that some sort of strong complex heteroscedasticity is there. But since one of these 2 tests goes in our favor, so we could say that the tests remain valid. But yes, there must be some sort of robust standard error that we need to apply in our regression model to eradicate the sort of heteroscedasticity. Now, to finally conclude, as we discussed and our stats proved, our regression model proved that inflation is co-moving strongly with oil market volatility. Our hypothesis stand valid. It has the oil has the most strong or the strongest relationship with inflation. Exchange rate pass-through, minimal monetary tightening, it aligns with the inflation cycle as a response maybe, and then over validation, the robust econometric validation is performed. Well, we can say this topic of us, we talked about US basically and its market and its the response of oil and federal exchange rate and the policy, the impact of policy rate changes in inflation for US market. But we can extend this observation to other markets as well, because we already know that this is that the US economy does have an impact on other economies of the world as well. For example, some markets as Pakistan, which heavily depend upon oil, it will definitely have an impact on Pakistan's market. If oil shocks its US and the resulting, say, monetary tightening of US market, it will spill over into emerging markets like maybe Pakistan, and it will also result in higher energy prices and similarly capital outflows, depreciation, etc. And similarly sort of imported inflation in Pakistan. So this topic is an attempt to understand how US inflation is impacted and its broader maybe impact on global macroeconomic trends, including those which affect Pakistan. So, well, that is all. Thank you.